This is video 1 of 8 covering the Exam 1 study guide. In this video, we're going to review Chapter 12, Conceptual Content, on pages 1 to 4. This is the primary study guide, not the extra practice problems. Okay, for Chapter 12, all 4 chapters are equally represented on the exam with 25 points each. Chapter 12, 15 of those points come from the written problem, which will basically be a statement of cash flows, and the other 10 come from multiple choice questions. Those multiple choice questions are going to cover concepts such as defining or describing the statement of cash flows, understanding what it is, what it's reporting. Will also involve questions that ask you to define exactly what is going into or what kind of accounts impact each of the individual sections of the statement of cash flows, and identifying examples of things that would be reported as a non-cash investing and financing activity. Okay, so what is the statement of cash flows? What does it report? As the name implies, it's the statement of cash flows. It's reporting cash in, cash out, over a certain period. It will tell us how those cash balances change, what kind of activities are driving those changes. It might be impacted by things like net income, balance sheet accounts, but it is distinct from those things. The report itself is centered around cash. Those other things are just, they're there to explain cash and nothing else. The focus is cash flows. Okay, there are 3 primary sections of the statement of cash flows: operating, investing, and financing, OIF. You need to know what goes in each of those sections. So in the operating section, the very first line will be net income. Then you'll make 2 types of adjustments to reconcile net income to cash flows. The first one will be still from the income statement, non-cash income items. For our class, that is basically a depreciation expense and any gains or losses. The point here in adjusting for those is to remove their effect. They're not cash items. I've reported net income. I'm trying to get net income. I'm trying to make adjustments to it to make it equal cash. So I've got to remove anything and its effect if it isn't actually a cash item. So you're reversing the effect. So depreciation expense or any expense or loss typically decreases net income. If I was reversing it, I would adjust by increasing or adding. A gain would increase net income, so to reverse its effect, I would need to decrease or subtract. For our class, what we're looking for non-cash income items is always depreciation, any kind of loss, and any kind of gain. You don't even have to worry about this debt retirement, sale of asset. If it's a gain or a loss in our income statement, in our class, that is a non-cash income item that we're going to adjust for. After we get net income, depreciation, gains, losses, we're finished with the income statement and we're going to move to the balance sheet. We do that in that second adjustment in the operating, where we adjust for changes in current assets and current liabilities. So get the changes, take the difference between this year and last year for each of those accounts, and then when you're making your adjustment, pay attention to whether or not the current asset or current liability is increasing or decreasing since last year. Think about what the relationship between current assets or current liabilities and those cash adjustments are. So if I were to think about what causes an account receivable to decrease, a common current asset, an account receivable reflects money that my customers owe me, money that I'm entitled to receive from my customers in the future. What could happen that would make me say that my customers do not owe me as much money anymore, that I'm not going to receive, or that I'm going to receive a lower amount at some point in the future? What would reduce how much I say that they must send me? I would reduce how much they owe me if they paid me. So if I receive cash, they pay me. Cash is increasing. The amount that they owe me is decreasing. So a decrease in a current asset, it corresponds to a increase in cash. So decrease, increase, or vice versa, increase, decrease. It has an inverse relationship. They're opposite. Current liabilities, on the other hand, so what we call a current liability, like an accounts payable, to decrease. An account payable reflects how much I owe, like a vendor or supplier. Why would I owe my vendor or supplier less? So I owe them money. What would make me owe them less? I could pay them. If I pay them, my cash goes down and the amount that I owe them goes down. So decreases correspond to decreases, also increases to increases. It has a direct relationship. So with that in mind, with current assets having an inverse relationship, an increase in a current asset would correspond to a decrease. An adjustment, I would need to decrease my adjustment. A decrease would correspond to an increase. I would need to add that adjustment back, or that change back. With the current liability, increases correspond to increases, decreases to decreases. So if I need to decrease an account, I would subtract. If I need to increase for an account change, I would add. At the very end of that section, as you will with all sections, you will determine if net cash was provided or used by that activity. If the total amount of cash from that activity is positive, then it's provided. If it's negative, then it was used. After I get that sum line, I begin my next section, investing. So just to remind you, we're on the balance sheet now. Current assets and current liabilities went to the operating section. The top line of the balance sheet was in operating. I would just work my way down the balance sheet now for the rest of this statement. At least with respect to like what kind of accounts are relevant. So for investing, I go to the next account type, which is long-term assets. So you're looking at like property, plant, equipment, those kind of things. I would say look at the balance sheet, use it to help identify accounts that are relevant. So find your long-term assets on the balance sheet, figure out what accounts you have that fall under that category. Once you know the accounts you're looking for, go to the additional info and look for any transactions involving those accounts that have a cash effect. Note that this is the statement of cash flows. Our concern is cash. So particularly for investing and financing, when you're reading those additional info items, focus on cash. Like, did we pay cash? Did we receive cash? Everything else in those is largely irrelevant, or at least it is with respect to reporting. You're going to report the cash effect. So pay attention to what they say is actually received or paid in cash. Once again, use some still provided or used, this time with label by investing activities. Then we would begin our final section, the financing activities section. I have two account types left at the very end of the balance sheet: long-term liabilities and equities. Once again, look at your balance sheet to identify those accounts, then go to additional info for the details about why they're changing. I would sum that up just like I did operating and investing, and would note provided or used. Same rules as before. So we'll do a summary actually at the end. So also know how to identify examples of non-cash investing and financing activities, and think about what that communicates: non-cash investing and financing. Non-cash means that cash cannot be changing hands. Investing suggests that you could have long-term asset accounts being the driver of the transactions, or financing means long-term liabilities or equity accounts. So basically, you should see no cash changing hands, and you should see one or more long-term assets, long-term liabilities, and or equities in the transaction. So here, I use a notes payable. That's a long-term liability, which is related to financing. To finance equipment, that's a long-term asset related to investing. I use a notes payable to finance that equipment that I purchased this year. And also note, there's no cash change. So that would indeed be non-cash investing and financing. There's both an investing and a financing related account and no cash. I use common stock. That's an equity, which is related to financing, to purchase equipment. Long-term asset related to investing. So I purchased some equipment with common stock. Also, no cash changing hands. So non-cash investing and financing. So it could actually be non-cash investing or financing. It doesn't have to be both an investing and a financing related activity, but there should be at least one. I pay off a notes payable. That's a long-term liability. So financing by issuing common stock. Equity, so financing. Both of those are financing related accounts. There's also no cash involved in this transaction. Even though there's no investing related account, this is just financing related accounts, it's still non-cash investing and financing. It doesn't have to be both. It would be more accurately named non-cash investing or financing, or financing. Basically though, if you've got no cash changing hands and transactions that involve long-term assets, long-term liabilities, and or equities, that's a non-cash investing and financing activity. So if I'm using cash, if I see cash is changing hands at all in the transaction, it cannot be a non-cash transaction. Additionally, if it involves operating activities, so if it was something like I bought inventory within accounts payable. Technically, there's no cash changing hands, but inventory is operating. It's current asset, so it's operating. Accounts payable is a current liability, so it's operating. There's no investing and financing activity involved, so this would still relate to operating. So just be aware of that. Particularly, these things would impact cash flows through those adjustments for current assets and current liability changes. Well, I shouldn't say that impact cash flows. They would impact what you're reporting in the operating section via those adjustments. Okay, let's summarize those three sections and what we have in each. Operating, the first section. It's the only one that concerns itself with the income statement. It reports net income, then it adjusts for non-cash income items, in particular, depreciation expense, and any gains or losses. Then it adjusts for changes in current assets and current liabilities. Current assets have an inverse relationship with cash. So if I've got an increase in a current asset, I would need to adjust by decreasing. If I have a decrease in a current asset, I would need to adjust by increasing or adding. Current liabilities have a direct relationship. So if I have an increase in a current liability, I want to adjust also by increasing or adding. If I have a decrease, adjust by decreasing or subtracting. So to summarize, my operating section would be any income related items, current assets or current liabilities. Investing is concerned with long-term assets, financing with long-term liabilities and equities. The last two items are account types on the balance sheet. Note that dividends are not necessarily explicitly reported in the equity section of the balance sheet, but they are implicitly via their effect on retained earnings. So if I see dividends, you should know that it's impacting retained earnings. Retained earnings, of course, is an equity account, so it would be financing related. Okay, that's the end of video 1. We'll pick back up in video 2 at the top of page 5.